Hey Richmond, Virginia, are you wondering whether or not the real estate market is crashing? We'll cover that today on your August 2022 Real Estate Market Update. What is going on, party people? My name is Elliott with the Elliott Real Estate Team. Appreciate you tuning in. If you would like, subscribe, do all that stuff before we get started. Let's just jump right into it. So, you are probably hearing a lot about the real estate market right now. If you're watching the news, if you're on YouTube, if you're talking with friends and family, there's a lot of differing opinions right now. Some people are in the camp that the real estate market is absolutely crashing. I am here to tell you that despite what you are hearing on the fear-mongering news, despite what you might be seeing in YouTube land, despite what your Uncle Larry might be saying, who, his side gig is being a real estate economist in his spare time, the real estate market is most definitely not crashing, certainly not in Richmond, Virginia. We have been seeing a market softening, but we are certainly not seeing a market crashing. And I'm going to break that down for you. But real quick, what is currently happening in our market? So if we look at this, median home price is currently at, or for the month of July, was at $380,000, okay? The median days on market, it's 6 days on market. That means if a home goes on the market, on average, or on median, I should say, it is selling within 6 days. That is certainly not a market crash. Month supply of inventory is rising, but we're still at 1 month supply of inventory. So just to give you a little bit of context there, 6 to 7 months supply of inventory is considered a neutral market. Anything above that is considered a buyer's market. We are trending upward, but we are still currently at 1 month supply of inventory, so still very much in a seller's market. And the median percentage of list price to sales price, in other words, how much of the asking price are sellers actually getting, right now is averaging, if you look at the graphic above my shoulder, you'll see that that is on a downward trend. But to give you some context, we're currently at 102.6 months, 102.6% of asking price. So boo-hoo, sellers are only getting 2.6% over their asking price on average currently. So as you can see, just strictly from the numbers in Metro Richmond, we are certainly not seeing a market crash at all. So you might be asking yourself, you might be questioning me, why is the market not crashing? I'm hearing all this stuff, I'm hearing some stuff about recession, the economy, all that. How is the market not crashing? So one of the biggest reasons and one of the simplest explanations as far as why the market has not crashed, well, most likely will not crash, is there is simply not enough inventory. There's simply not enough supply of homes to tip the scales that we're currently seeing on the supply and demand curve. So you've got to ask yourself, where does real estate inventory come from? What comprises real estate inventory? Where do we see these houses come from? And I'm going to tell you 3 different sources. It is new construction, it is resale inventory, meaning folks that currently own homes that are putting them up for sale, and it is bank foreclosures, where a bank takes a property back from somebody that defaults on the mortgage, and they put that property back on the market to sell that to get the asset off of their books. So let's go through this. So with new construction, if you look at the graphic over my shoulder, you will see that we've been underbuilding homes for the last 14 years. So we've been below the 50-year average of new homes built for the last 14 years in a row. We're starting to catch up, but we're definitely not able to replenish what we've missed not being built over the last 14 years. The reason being is when 2008 happened, builders got seriously whacked. A lot of subcontractors that were in the business got out of the business. So simply put, the new home building business has been understaffed for the last 14 years, and new builders simply cannot keep up with the demand that is currently out there. And they're certainly not able to build the homes that were missed over the last 14 years. So that's that. Secondly, because of the lack of new construction, the resale market has been slow. So generally speaking, folks that own homes, one of the biggest drivers of people selling homes that currently own homes is they wanted to move into a new, shinier, prettier, bigger home. Without that new construction inventory, there's naturally going to be less resale opportunities because those folks that were leaving their current home to go into a new home, those folks simply don't exist. The other interesting little tidbit as far as resale inventory going forward, as you know, we've been in or as you may or may not know, we've been in a mortgage market that was below 3% over the last 2 years. We're certainly not seeing those rates anymore. But experts are predicting that we're going to see a little bit of a tough time with resale inventory for years to come, because you have all these people that are living in homes that have locked in these really low, cheap interest rates, that it's going to be very tough for somebody to move out of a 2.5%, 2.75% interest rate into a bigger home at a 5 to 6% interest rate. So kind of an interesting tidbit on resale inventory. And last but not least, foreclosure inventory. So you might be saying, oh my gosh, there's a wave of foreclosures happening. We're going to go into a recession. Everybody's going to be losing their home, all this nonsense. If you look at the numbers, foreclosures were at a 16-year low this past year in 2021. Reason being, simply put, homes have appreciated a good amount. So even folks that have found themselves in distressed situations where they needed to get rid of their property, they weren't able to keep up with their mortgage payments, those folks were able to sell traditionally because they didn't just have to let the property go. They had equity in the property, they were able to afford to pay a real estate commission, so they were able to put those homes on the market, get them sold for fair market value. And yes, maybe they didn't necessarily want to part with their homes, but they were able to sell it without just giving it back to the bank and having their credit be destroyed. Another reason we haven't seen a ton of foreclosures, and we most likely won't be seeing a ton of foreclosures hit the market, is lending standards are dramatically different from what they were in the run-up to 2008. So what you need to understand, if you look at the graphic, you will see this is an index that basically shows how easy it is to get a mortgage loan. The lower that number, the harder it is to get credit. The higher that number, the easier it is to get a loan. We had a lot of folks going into 2008 that got loans that necessarily shouldn't have. There were no documentation loans where you basically just tell the lender what you made. They just took your word for it and they were giving out loans. So we had a lot of people getting into loan products that shouldn't have been getting into it. It's much harder to get a loan these days. Banks are much more conservative in the money they are lending, and therefore there's not as many people that are going to naturally default because they did a better job pre-qualifying these folks before they got them into these loans. So last but not least, what is in store for the remainder of 2022? So mortgage rates have definitely been volatile, but they seem to have been stabilized here in the 5% range, 5 to 6% over the last few months. This leads experts to predict that rates will stay in the 5s basically for the next year through Q3 of 2023. Freddie Mac, Fannie Mae, and the Mortgage Bankers Association actually predict that rates will slowly creep down. National Association of Realtors doesn't necessarily feel the same way, but nobody's really predicting a sharp rise in interest rates or really a sharp decline in interest rates over the next year. Also, important to note, experts predict, now once again, I know your Uncle Larry is a real estate economist in his spare time. I know you've probably seen something on YouTube or on social media saying the real estate market is going to crash, but all of these major institutions that make these predictions predict that we will see a 10% appreciation rate through 2022. So basically where homes were at the beginning of this year to where homes will be at, home prices will be at by the end of this year. And I can tell you in Metro Richmond, we currently are sitting at a 13.4% appreciation rate year over year. So looking at where prices were July of 2021 to where they are July of 2022, just looking back a month, we're currently sitting at 13.4% appreciation rate. So I hope this educated you. I hope this maybe brought some ease and some calm into your world. If you have any questions, concerns that we didn't address in this video, definitely either shoot me a DM or throw it in the comments below. I appreciate you tuning in. I look forward to seeing you next month.